One of the most popular questions I get asked as a tax expert is, how do I write off my car? One of the perks of being an entrepreneur is getting a nice car through your business. Instead of just paying out of pocket, what's better than getting your business to pay for it and getting a tax deduction for it? As tempting as it is, there are certain limitations that you need to be careful of that the Canadian Revenue Agency or the CRA imposes. Vehicle-related deductions are also one of the most audited areas, so make sure to watch the entire video to understand what your options are. So what is business purpose? General rule of thumb is that you can only deduct the portion of the vehicle costs that are related to reasonable business use. Some examples of business uses are when you are meeting clients and attending conferences, purchasing supplies your business needs to operate, running errands for your business, as well as visiting customers or clients. Alternatively, personal use cases in which vehicle costs are not deductible are driving from the office to the grocery store to buy dinner for your family, driving to and from the office or place of work to home. Now let's dive into the types of vehicle deductions that you can take. In the case where you purchase a car, you take a deduction called depreciation, or specifically the tax term for it is capital cost allowance. And this we'll be diving into a little bit more detail later in this video. The second type of cost is when you lease a car. You are able to take eligible leasing costs, which requires a separate calculation. You can also take deductions for general vehicle expenses, such as fuel and oil costs, electricity costs for zero emission vehicles, license and registration fees, insurance, as well as interest on money borrowed to buy a motor vehicle, maintenance and repair costs, as well as 100% of parking fees if it is specifically related to business. Otherwise, if it's a personal cost, then that is not deductible at all. Other costs of getting into a car accident is 100% deductible if it's specifically related to a business trip. If you're finding this video useful so far, let me know by tapping the like button down below. Let's get into the options that you have as to how you can structure owning a vehicle through your business. There are different structures available depending on whether you are a sole proprietor or a corporation. And if you want to learn more about the difference between the two, I actually made a video about it, so make sure to check it out above. So the different options are, as a self-employed, you can buy the vehicle and then take the business use percentages relevant for depreciation or eligible leasing costs, as well as vehicle expenses. As a corporation, you have the following options, which are the corporation buying or leasing the vehicle and then taking the appropriate deductions. For a personal use case, the employee would need to include it in their taxable income. Now, a different structure is if the employee / shareholder has a personal vehicle that they use for business purposes on behalf of the corporation, then the corporation could provide an allowance for the employee. And I'll be diving into more details about capital cost allowance and leasing costs, so make sure that you watch until the very end. Buying versus leasing. So one of the most popular questions that get asked is whether to buy or lease. It's actually not so simple to answer because it really depends on your specific situation. I know, not the answer that you're looking for. Some questions that you can ask yourself are, how much do you expect to drive? Do you drive a lot, or do you drive only a few kilometers per year? Do you plan to switch out your car every 2 or 3 years, or do you want to keep it for the long term? What is your budget? Compare the leasing versus buying monthly payment options. After you have considered the non-tax related questions, let's jump into the tax deductions you can get from the two options. So for leasing, the maximum monthly lease payments you can deduct is $800 per month plus GST or HST, which just increased to $900 plus tax starting this January 1st, 2022. So that means if your lease costs $500 per month and you use a vehicle 80% of the time for business purposes, you can deduct $400 per month. However, if your lease is $1,000 per month, then you can only deduct a maximum of $800 if you use your car 100% of the time for business purposes. However, if the car is considered a luxury vehicle, then there may be some limitations on how much leasing costs you can deduct. So check out the calculations, which I'll be linking down below for your reference. In the case of buying a vehicle outright, you can't deduct the full amount right away. First, you need to capitalize the cost of the vehicle, and then you need to take depreciation expense on it based on CRA's prescribed rate called the capital cost allowance, or CCA. Depending on what type of vehicle type, there is a limit on how much cost you can capitalize. So for most passenger vehicles, there is a cap of $34,000 as of this January 1st, 2022. And this is actually an increase from $30,000, which was a cap for many years. But because of inflation, the CRA or the government has increased that cap this year. What this is telling you is that you can't go out and buy a luxury vehicle of $100,000 and expect to take the full deduction. For zero emission passenger vehicles, the allowable cost is actually much higher at $59,000. This is telling you is that the government is trying to incentivize you to buy electric cars to better the environment. As part of the budget 2019, you can take accelerated depreciation by taking a full 100% deduction of the zero emission vehicle. That means that if you purchase an eligible zero emission vehicle, you'll be able to deduct 100% of the $59,000 cost in the year if it was purchased after March 18, 2019 and before January 1st, 2028. So you still have a couple of years to take advantage of this benefit. And this is a huge benefit compared to purchasing regular passenger vehicles where you could only capitalize $34,000 per year and you can't take the full deduction. You can only take 30% depreciation per year. So this means that if you had a super profitable year and you plan it out correctly, buying the right vehicle, specifically a zero emission vehicle, can be a super beneficial write-off that can really reduce your taxes by thousands of dollars. Now, when there is a corporation involved, as mentioned previously, there's a couple of structures that you can take into consideration. The first case is when the corporation purchases or leases the vehicle. In most cases, the employee uses vehicles for some personal use and not just 100% business use all the time. In this case, the employee would need to include the personal use portion in their taxable income. So you might be wondering, how do you calculate what that taxable benefit is? So there are two components to include as taxable benefits. The first is operating costs, and this includes gas, oil, maintenance charges, repairs. And for 2022, the benefit is calculated by 29 cents per kilometer of personal use. The second type of taxable benefit would be the standby charge, and this basically relates to the depreciation or the wear and tear of the vehicle. The calculation for standby charges can get quite tricky, so the CRA provides an online calculator that you can use, which I'll be linking in the description box down below. There is also a reduced standby charge if the vehicle is primarily used for business purposes, and this means that more than 50% of the time is used for business purposes, and 1,667 kilometers per month, or a total of 20,004 kilometers per year, is not exceeded when using the vehicle for personal driving. This actually makes a huge difference since the reduced standby charges is almost half of the regular standby charges. So this is an important concept to take into consideration when you use a vehicle for personal use. Alternatively, the employee/shareholder can use their personal vehicle for business purposes and then have the corporation provide you a reasonable allowance rate that is reimbursed based on the number of business kilometers driven in a year. For 2022, the reasonable allowance rates are 61 cents per kilometer for the first 5,000 kilometers driven, and then 55 cents per kilometer driven after that. In this case, there will be no other vehicle expenses that are reimbursed. Good practices. As mentioned earlier, vehicle deductions are one of the most audited areas by the CRA. So it's particularly important to keep all supporting documentation. Information that you should keep on file are all receipts, the total kilometers that you drove in the year, as well as the kilometers that you drove specifically to earn business income. You also need to keep on file the date, the destination, the purpose, and the number of kilometers driven in that particular trip by recording the odometer at the start and the end of the fiscal period. I know it may sound a little daunting to keep track of everything, and this seems like a lot of information, but there are softwares and apps out there that can make your life so much easier. So make sure that you take advantage of them. There are apps out there where you could just snap the receipts and it will expense it for you, as well as there are apps that actually keep track of your kilometer automatically. If you want to learn more about top 5 tax deductions that businesses often miss, check out my next video here. Thanks for watching, and I'll see you in my next one. Bye!